It's Friday, 6th of September, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Now, this podcast usually goes out late Sunday, UK, early Monday, Asia, but that payrolls release, it means we wanted to get this out ASAP. The report has just dropped, and we are recording this just as the US market opens. I've got Group Chief Economist Neil Shearing and Paul Ashworth, our Chief North America Economist, with me to walk through the data. Paul, I wanted to start with you. What are the key takeaways from these employment data? I mean, the market reaction certainly isn't as violent as it was to the July report.
No, I think it was a pretty mixed report. I mean, clearly there's a slowdown going on in the labour market, but I wouldn't go as far to call it anything like a collapse. So employment growth, again, in non-farm payrolls slowed to 142,000 in August, which was a tiny bit below consensus, but not dramatically so. We had a small drop back in the unemployment rate to 4.2% from 4.3%. So that was encouraging, if only because the unemployment rate didn't continue to go even higher. And then within that, we had a bit of a bounce back in the household survey measure of employment. So the proverbial mixed bag, really.
A mixed bag indeed. Going into this report, we had expected at least some of the hit in July that we described to Hurricane Beryl to be reversed. Did we see that coming back?
I think to a certain extent, yes. I mean, some of the strength in employment was in the construction and leisure and hospitality sectors in August, which we do think of as being weather sensitive. And certainly the drop back in the unemployment rate was partly driven by a normalisation in temporary layoffs, which again would have been partly attributed to the distortion caused by the hurricane in July.
Your written response to the release made this point that this is a labour market that looks like it's slowing, not crashing, the kind of fears that the July report had sparked. Got to ask you, we've got the Fed meeting on 17th, 18th of September. As you know, based on this report, where do we stand in terms of the 25 or 50 basis point cut?
Well, I think we probably narrowly favour a 25 basis point cut. The Fed certainly won't want to suggest there's any reason to panic. There's nothing coming from Fed officials themselves. There's a desperate need for a 50 basis point cut. The futures markets seem to be about evenly split on this post-payrolls release. But I think it's not just about what the Fed starts with, it's how deep the cuts are cumulatively over the next couple of years, or next 12 months at least anyway. And certainly if the labour market continues to weaken as it is doing, then the balance of risks to our view that the Fed funds rate will bottom out, but still slightly north of 3% might need to be reassessed. And maybe the Fed needs to cut rates a bit more dramatically. Again, it's a bit early to come to a firm conclusion on that.
But it doesn't sound like, from what you're saying, that recession risks are going away anytime soon.
I mean, 142,000 is still a pretty healthy gain in payrolls, particularly in an environment where productivity growth is running at close to 3%. Because that means even with zero employment growth, you can get GDP growth at 3%. So this labour market slowdown is consistent with our scenarios dashboard that we use to track various high-low scenarios for both inflation and GDP growth for the US economy. And right now that's suggesting that the most likely outcome is a soft landing. A hard landing, the probability has been rising in recent months, but the probability overall is still relatively low. So, I think recession risks are still a bit overblown. I mean, certainly it can't be completely discounted, but I don't see any imminent signs of the US plummeting towards a recession.
What about inflation? Coming week, we've got August inflation data due. I think that's the last big release before the Fed meeting. Is there anything you think in that report that could change our forecast for this easing cycle to start with a 25 basis point move? Or is the inflation debate largely settled at this point in terms of how monetary easing begins?
I think the Fed's now fairly confident that inflation will get back to 2% and stay there. So unless the August report dramatically deviates from that narrative, either like we saw between January and March, we get an unexpected resurgence in inflation, or it comes in particularly weak, then I don't think it's going to change the odds of what the Fed does with its September rate decision a lot. I mean, certainly our provisional preview for the report is that it will come in broadly consistent with a 2% target, at least the PCE data.
Neil, I'd like to bring you in here because I wanted to ask the extent to which these jitters about the health of the US economy, to what extent is this a global issue? How much does the hard landing, soft landing debate compare with what we're seeing in other major economies?
Well, I think there's some echoes of what's happening in the US playing out in other economies. Perhaps not yet much sign of labour market weakness or cooling, particularly in Europe. Actually, labour markets in Europe are particularly tight. And there might be a few reasons for that. One of those might be the strength of immigration in the US, meaning that labour supply has been perhaps a bit stronger than is the case in Europe, and that's kept labour markets in Europe tighter. On the other hand, I think there's much greater evidence actually that manufacturing and industrial sectors in Europe and elsewhere are struggling to a greater extent than is the case in the US. We're talking on Friday. We just had German industrial production data for July. That was pretty awful. That was down more than 3% in the month. In France, industrial production was down 0.5% on the month in July. We're going to get the Eurozone industrial production data for the single currency area as a whole in the coming week. For July, we've penciled in a fall of just over 2% month on month. So actually much greater evidence of industrial weakness in Europe than is the case in the US. The question for the ECB and for policymakers in Europe is how much of that is cyclical weakness versus structural weakness. If it's structural weakness, there's not much they can do about it, in particular by for example, by cutting interest rates. And in the case of Germany, we think a good chunk of this is actually structural. So ECB's meeting next week against a backdrop of tight labour markets, but weak activity data, and that's a pretty uncomfortable place for policymakers to be.
So to what extent, I mean, is it largely a manufacturing story? And if so, if we see more weakness in manufacturing, does that then suggest a more challenging outlook for activity more generally?
Well, the manufacturing sector is always more cyclical. Services tend to be a bit more steady through the cycle, and it's manufacturing that tends to be the more cyclical part of economies. On the other hand, this cycle, as we've discussed on this podcast before, has been a little strange because the manufacturing sector in particular has been buffeted by COVID, surges in demand for consumer goods in 2020, 2021, then the need to restore inventory in 2022. All of that washed through in 2023, and we had manufacturing recessions. And now I think we're starting to see some signs of normality returning as producers have worked through backlogs of orders. So I think the role that industry has played and manufacturing has played as an indicator of the cyclical health of economies, I think may not necessarily hold in this cycle, given it's been a bit strange. However, I think it's pretty clear that industry in Europe is weak. And as I say, some of that is for structural reasons as much as cyclical.
You mentioned policymakers, you mentioned the challenges facing policymakers. You also mentioned those German IP numbers for July. I mean, they've got to make for pretty uncomfortable reading at the ECB. Talk a bit more about what we're expecting from the Governing Council this Thursday. What do you think is going to be the scope of debate, and what's the outcome going to look like?
Well, they've already telegraphed a cut, and I suspect that cut's going to be 25 basis points. That's pretty much fully priced into the market. So I think the outcome of the meeting itself, there is little doubt about. However, what's going to be interesting and what we will be paying close attention to is the debate on the Governing Council and the extent to which we get any sense in the accompanying statement and in particular press conference about splits on the Governing Council between hawks and doves. At the moment, as you say, it's a case of picking your poison. Do you focus on the weak activity data if you're a policymaker on the ECB's Governing Council, or do you focus on the still tight labour market and the still elevated rates of services inflation? That split on the Governing Council, I think, means they're going to be very, very slow to cut interest rates. They're going to take things at a gradual pace. So we've penciled in one 25 basis point cut in every quarter through the next year and a half or so. If we have a September cut, that will be the cut for Q3. And I think we'll get one more 25 basis point cut in Q4 by the ECB. That contrasts with the view as course set out for the Fed, where we've got 3 25 basis point cuts at each of the next 3 FOMC meetings.
That was Neil Shearing and Paul Ashworth on that US payrolls report on the Fed, the ECB, and recession risks, US and global. I will link to Paul's payrolls response to our ECB preview and to our US scenarios dashboard in the podcast notes. That dashboard's getting refreshed on Monday as it does each week, so bookmark it now and keep an eye on it. It was created in response to client requests for a tool that cuts through the noise and gives a simple guide to whether it's a US soft landing, hard landing, or something else that's probable. And it does just that. It's a benefit of CE Advance, our premium platform, and it comes with access to the data for export. Find out more about our data offerings, including Excel plugins and APIs at capitaleconomics.com/data. I also want to flag some events in the coming week. On Tuesday, our US CRE team is holding a drop-in. That's one of our short-form online briefings to tell clients all about why they should be falling back in love with US retail assets. And on Wednesday, it's our commodities team online to explain what's been driving gold prices to record highs and whether there's more upside from here. And on Thursday, we're holding an in-person event in London all about the UK macro and market outlook. I think that event is at full capacity, but do register interest via our events page if you want to see about attending. That's capitaleconomics.com/events. We've got another event in London later in September. That's on the 24th. It's all about the Asia outlook, including what's happening to China's economy and the impact of the US election. And our team in the Asia region are going to be hosting events in Singapore and Hong Kong in October, also to talk about the US election impact on economies in Asia. Again, all the details on capitaleconomics.com/events. But that's it for this week. Join me next week when Neil will be back to review that ECB meeting, to preview the Bank of England and, of course, the Fed meetings the following week, and to dig into the other big issues in global macro and markets. But until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.